Well, really, the way I look at it is there's really only been two themes that have driven global markets year to date. The first is that the US dollar has at least partly lost its store of value function. And the second is that the world is shifting towards a wartime economy that favors industrial production and stockpiling. Both of these themes essentially explain nearly all of the price action across all precious metals, base metals, and more broadly in the critical mineral space. Yeah, that's a really good point, and I think the latter, which is continued threats on the Fed's independence, are really the key here. Ultimately, if you zoom out, right, we started this year with gold being severely underowned, particularly in the West. For most of the time in which gold has been in a bull market, the East has been driving the rally in gold, and 2025 is the year where the West has meaningfully participated. Even if we dig in a little bit more into that, right, and we start to think about, well, how widely populated is the gold trade now? I would point out that institutional ownership of the largest gold ETF is now roughly 65% as popular as the most popular ETF in history, which is, of course, the SPY. So that tells you that there has been a significant increase in the number of institutions that are holding gold. And the question for 2026 is, are their position sizes going to change? Right now that we've reached this kind of widespread adoption in gold, we need the industry to decisively change their asset allocations for gold prices to meaningfully shift higher from here. A lot of things have to go right for that to happen, and there's a lot of catalysts on the way. The earliest one is Lisa Cook's trial, which will determine whether the Trump administration can exit a sitting member of the Board of Governors within the Federal Reserve. Yeah. Well, listen, nearly a year ago, I sat across from you at this very table, and we argued that silver was heading towards a silver squeeze that you can buy into. That was catalyzed or premised on this idea that the threat of tariffs in the United States was going to drain metal away from London into the United States. This has occurred, and it drove London inventories below levels that were critical for its market threshold. That is ultimately what drove silver up until mid October, which was the silver squeeze moment in our view. Since then, in our view, we've actually seen a record increase in London silver inventories, right? This is the single largest wave of repletion in London free floating inventory balances on record. And yet the prices have continued to trade substantially higher. The inflows into silver are notable, but they're not extraordinary, and yet the price action is. And that tells you that liquidity conditions are still constrained. This time, liquidity constraints are no longer originating from the lack of physical availability, in our view, but rather from the frictions to an arbitrage process, is now undermining that liquidity process. And as a result of that, it takes a lot less in terms of dollar inflows to have a large price impact. A few facts, Devin, that a lot of people might not want to hear, actually. But if you look at the consensus setting agencies for silver markets, the deficit for 2025 has been meaningfully revised lower. For 2026, we're talking about only a 40 million ounce deficit, which can easily be swung by ETF inflows or outflows. So the setup here in silver has meaningfully changed, and we think that by mid-January, we could see a sharp correction in prices. Sure. Well, from a fundamental perspective, the consensus expects the peak internal combustion engine theme to result in a meaningful drain on demand growth or outright demand levels going forward for both platinum and palladium. That has been the consensus for some time. And for 2026, most people also expect a revival in scrap supply, which is a meaningful portion of total supply for platinum group metals, to drive balances substantially worse off than they are today. What we're seeing is different. we're seeing a deurbanization trend in North America that really commenced with the pandemic, but that continues on course for 2026. And the implication of this deurbanization trend is that the average household in the United States is increasing the number of vehicles per household that they own. The result is a very meaningful shift in both PGM demand and PGM scrap supply, because in a 2.2 vehicle per household society, which is the United States, you're no longer scrapping a vehicle when you want to replace this vehicle. What you're doing is that household is making a decision on whether they want to be a two vehicle household or a three vehicle household, and the implications are very significant for both supply and demand. Well, I think that there's a lot of stories out there about very significant shift in allocations towards commodities. My concern is that this is only achievable at substantially higher commodity price levels. But as we're seeing, even at today's levels, for many of these critical minerals, you're incentivizing demand destruction. Right. So let's go back to silver, which has had an outstanding year. We started off the year, and we're now more than 100% higher from where we started. The implication now is that silver in a solar cell used to represent about 7% of the cost structure in a solar cell, and it now represents north of 25% of the cost structure. So solar cell manufacturers are now extremely incentivized to thrift the silver away. And that is the reason why consensus setting agencies have meaningfully revised lower their expectations for deficits on the horizon.